Welcome to vTalkInsight, Market Drivers Daily for February 9th, 2026. AI spending anxiety, a surprisingly resilient growth backdrop, and violent rotations beneath COM index levels are all colliding today, forcing investors to reassess where the real risks and opportunities now sit across portfolios. AI remains the dominant structural story, but the market is clearly shifting from celebrating the sheer scale of spending to demanding proof of returns. Earlier in the week, we discussed how sentiment was already turning more discriminating, and that tension has only intensified as major platforms outline record capital plans while their share prices come under pressure. Top U.S. tech firms together are now pointing to roughly $650 to $700 billion of AI-related capital expenditure this year alone, with one company guiding toward about $200 billion of its own, and investors are openly questioning whether cash flows can keep up with that pace. Under the surface, this investment wave is already large enough to matter for growth. Tech-driven capital spending is estimated to add around 50 basis points to U.S. GDP this year, and AI-related Capex is currently about 1.5% of GDP, with scenarios pointing toward something closer to 5% by the end of the decade. Hyperscaler infrastructure spending tied to AI and cloud is expected to reach roughly $660 billion, and central banks in Europe are explicitly citing that data center build-out as one reason they feel more confident about the growth outlook, even if the timing and size of productivity gains remain uncertain. Unlike some past cycles, there is no clear sign of excess hardware capacity yet. GPUs remain fully utilized and can even appreciate in value, which supports the case for a multi-year build phase rather than a short-lived bubble. That said, AI is already tearing up old playbooks across software, legal, and financial services. Tools that can write code, draft legal documents, and analyze financial data are eroding traditional moats, leaving some listed software companies facing what investors increasingly describe as existential risk unless they pivot quickly to integrate AI. At the same time, enterprise-focused platforms such as Anthropic are gaining real traction, with hundreds of thousands of corporate customers and especially rapid adoption in financial services analytics. Banks like Banco Sabadell are leaning into this shift, reporting that AI-driven digital agents are already matching human performance in client service and recoveries, and expecting sizable efficiency benefits over the next 5 years. Across professional services, clients are starting to demand fee cuts as automation advances, reinforcing the view that AI could be structurally disinflationary for many white-collar industries. The most visible casualty so far is listed software. The S&P Software Index is on track to erase about $1 trillion of market value. U.S. software stocks are down around 17% year-to-date and lag the broader index by nearly 30 percentage points over 6 months, and individual names have seen outsized drops after weak guidance. Fears that AI will commoditize core products have triggered indiscriminate selling, even among highly profitable franchises, while mega-cap platforms announcing very aggressive AI infrastructure budgets have also been punished with share declines in the mid to high single digits. Yet within this turmoil, AI is already delivering tangible earnings support in digital advertising, commerce, and cloud computing, with companies such as Meta and Alphabet held up as examples where generative AI is clearly lifting engagement and monetization. A striking feature of this AI-driven shakeout is how calm credit markets remain. Despite headlines about $700 billion of planned spending among the largest tech firms and rising use of bond and equity issuance to fund that Capex, credit spreads for these issuers stay tight, signaling that lenders still view the balance sheets and cash flow profiles as resilient. The greater concern is in private credit and venture, where leverage is higher and disclosures thinner. Some business development companies and private vehicles with heavy software exposure are already under pressure, and investors are acutely aware that AI disruption could impair collateral values in ways that are slow to surface. Even within the AI leaders, there are fault lines, with OpenAI, for example, facing questions about the durability of its enterprise revenue model and its ability to keep financing very large cloud commitments. There's a credible counterview that parts of the equity sell-off have overshot. Some investors argue that the disruptive impact of large language models will take years to fully work through, that many hyperscaler Capex plans are backed by pre-committed customer demand for compute, and that AI infrastructure spending will likely run at elevated levels for another 7 to 8 years. However, the current panic around tech Capex and disruption is expected to linger for at least the next 6 months, because markets now want hard evidence of productivity gains, margin durability, and clear separation between structural winners and legacy models. Key watch points are how quickly cloud revenue and margins respond to this spending, how enterprise platforms such as Anthropic convert usage into sustainable profit streams, and whether credit markets stay as relaxed as they are today. Those outcomes will heavily influence how investors frame the broader growth story, which is where we turn next. Against this noisy AI backdrop, the macro picture still shows a surprisingly resilient and in some places accelerating growth trend. U.S. nominal GDP grew at more than 8% last quarter, a pace rarely seen outside the immediate post-pandemic period, and the latest ISM Purchasing Managers Index has returned to an expansionary reading of 52 with strong new orders and stable input prices. Market breadth has improved meaningfully, with broad-based rallies that include mid-caps, transports, and the Dow hitting record highs, all pointing to an economy that is not solely reliant on a handful of mega-cap tech names. Household net worth is at record levels. Unemployment is still relatively low, and corporate investment remains solid, creating a backdrop in which AI Capex augments, rather than replaces, other growth drivers. AI and related technology spending are becoming an important incremental engine in that growth mix. Tech capital expenditures alone are estimated to add roughly 0.5 percentage point to U.S. GDP this year, and AI-driven investment is expected to rise from around 1.5% of GDP towards something closer to 5% by the end of the decade. Global growth forecasts around 2 to 2.5% for the U.S. may therefore prove conservative if hyperscaler and corporate Capex plans are executed on schedule. Central banks in Europe are already citing the AI investment boom and data center construction as reasons for a better regional outlook, expecting that eventual productivity gains will help offset aging demographics and slower labor force growth, even if the exact timing is hard to pin down. Growth is also broadening geographically and sectorally beyond U.S. tech. Emerging market assets are supported by stable inflation, positive real yields, and renewed growth momentum, with currency opportunities particularly noted in Brazil and South Africa thanks to favorable rate dynamics. There is constructive sentiment toward Europe and Japan as well, where a mix of fiscal expansion and upcoming political developments could unlock domestic demand, while European construction names, such as Vinci and Veolia, are already benefiting for data center infrastructure demand. In real assets, companies like Ventas are deploying around $2.5 billion into senior housing, with occupancy already near 86% and demographic tailwinds pointing to higher net operating income, while restored funding for biomedical research adds a slower but steady growth pillar. On the consumer side, several micro trends illustrate how spending power and engagement remain robust. Legal U.S. sportsbooks are expected to set a Super Bowl handle record of about $1.7 billion, while trading on prediction markets tied to the game has already exceeded $800 million, highlighting the rapid growth and financialization of sports and event-driven betting. Platforms like DraftKings are deepening their role, forming partnerships with crypto-related firms and planning to expand prediction markets into areas such as politics and entertainment, even as sports remain the core revenue driver. Buy now, pay later is another pocket of momentum, with a firm reporting roughly 30% year-over-year sales growth, a 42% increase in active merchants, and promotional events that boosted partner sales by more than a quarter in just a few days, supported by proprietary underwriting data that management views as a durable competitive edge. Brands are also leaning on major cultural moments, such as the Super Bowl, to launch premium products and, in the case of AI firms, to shape public perception and build trust around new technologies. Set against these positives are several important constraints that investors are watching closely. There is a clear concern that sovereign and corporate debt loads could become more problematic if the hoped-for productivity gains from AI and broader Capex do not arrive quickly enough. AI is also reshaping the labor market. About half of the recent uptick in unemployment is estimated to be structural and linked to automation, even as consumer spending holds up and hiring rates remain unusually low. AI-driven cost reductions are already putting pressure on service sector pricing, as seen in client demands for lower professional fees, which may reinforce disinflation but could also challenge profit pools in parts of the economy. For the U.S. specifically, there is vulnerability if equity markets suffer a deeper correction, because growth is highly reliant on AI-driven investment and consumption by wealthier households with large market exposure. Pulling this together, the growth backdrop still leans constructive, but the range of outcomes is widening. On the upside, global GDP could surprise positively if AI Capex continues at current pace, manufacturing and services surveys stay in expansion, and emerging markets maintain real yield and currency advantages. On the downside, a combination of equity market stress, slower monetization of tech spending, and rising political or regulatory pushback against energy-intensive data centers could quickly cool Capex and confidence. Key indicators to monitor from here include incoming ISM and payroll data, Capex guidance from AI-heavy corporates, flows into emerging market assets, and any shift in messaging from central banks that might either validate or challenge the current acceleration narrative. How those signals evolve will interact directly with the sharp market divergences now visible across regions, styles, and asset classes. The most striking feature of markets right now is how different the picture looks once you move beyond headline indices. Despite the S&P 500 sitting near all-time highs in broad days where it rallies almost 2%, leadership under the surface has flipped repeatedly, with violent moves between sectors, styles, and regions. U.S. software stocks are down around 17% year-to-date. The Nasdaq 100 futures are negative and roughly 3% lower for the year, while a number of mega-cap tech names have seen single-day drops of 5 to 8% on AI Capex news. At the same time, sectors tied more closely to the real economy, such as industrials, energy, and parts of semiconductors, have been comparatively resilient, suggesting a rotation toward companies with visible earnings leverage to existing demand rather than purely to AI narratives. Divergence is also acute within technology itself. Semiconductor equipment and component makers have outperformed in early 2026. Yet marquee chip names like NVIDIA and Broadcom have lagged despite strong fundamentals and, in some cases, more attractive valuations. NVIDIA in particular is capturing a disproportionate share of profits from the AI infrastructure build-out, yet now trades on a lower multiple than several of the large cloud platforms that are spending heavily on Capex. Among the mega-caps, Amazon has been punished for weaker cloud growth and a $200 billion Capex plan, while Alphabet is seen as better positioned thanks to stronger cloud revenue growth and clearer AI monetization. Outside tech, European autos such as Stellantis have fallen close to 20%, sharply underperforming peers like SAP and Roche, while European construction stocks have outperformed on the back of data center demand, and homebuilders in the U.S. remain up around 12% year-to-date despite regulatory noise. Size and style factors are telling their own story. Small caps and mid caps have sharply outpaced large cap growth, with the Russell 2000 and S&P 400 hitting record highs even as the Nasdaq underperforms, and recent breadth has been driven more by speculative growth and smaller names than by traditional quality or value factors. There are early signs of a rotation toward quality and value. However, as investors reassess stretch valuations in some AI-exposed names and seek more balanced earnings profiles. Geographically, equity market leadership is rotating away from the U.S. towards select non-U.S. markets. International equities are up solidly year-to-date, while top U.S. tech stocks lag, and flows are picking up into Europe, Japan, South Korea, and certain high-yielding emerging markets. A weaker dollar trend is supporting this shift, and the fact that European households have relatively low direct equity exposure reduces the risk that a U.S. correction would spill over into European consumption via wealth effects. Cross-asset signals further underscore this divergence theme. Momentum trades in Bitcoin, gold, and silver have sharply unwound, exposing leverage positioning and helping to drive volatility in commodity-heavy indices like the FTSE 100, which contrasts with relative strength in the DAX. Factor-driven trading has dominated recent sessions, with stock moves often more correlated with style and factor baskets than with company-specific earnings news, which in turn creates longer-term opportunities for investors who can look through short-term noise. Perhaps most importantly, credit markets remain calm, with tight spreads even as equity investors slash valuations for software, certain private credit vehicles, and some basic resources names following events like the collapse of merger talks between Rio Tinto and Glencore. The U.S. yield curve is now at its steepest in 4 years, with roughly 72 basis points between 2- and 10-year treasuries, signaling changing expectations for growth and monetary policy that may not yet be fully reflected in equity pricing. These patterns are reshaping how investors think about concentration and diversification. After a long period of narrow leadership, diversification strategies are regaining relevance as the earnings growth gap between mega-cap tech and the rest of the market narrows. We are seeing reallocations away from concentrated U.S. tech toward emerging markets, European equities, and international tech with more asset-light models, alongside a renewed focus on diversification across the AI value chain rather than just owning the largest platforms. Active management is widely expected to fare better than passive in this environment because higher dispersion and frequent factor-driven mispricings create more scope for skilled stock pickers to add value. At the same time, investors remain cautious and selective, demanding clearer evidence of AI monetization, sustainable margins, and balance sheet discipline before committing to any particular part of the growth story. Looking ahead, the central question is whether this broadening of leadership proves durable or is simply another rotation within an ongoing AI-centric bull market. One plausible path is that small and mid-cap leadership, emerging market resilience, and non-U.S. outperformance continue, especially if rates stabilize and global growth data stay firm. The alternative is that confirmation of strong returns on AI Capex, or a renewed policy-driven bid for U.S. growth stocks, pulls leadership back toward a narrower set of mega-cap names, leaving diversified portfolios underperforming for a time. Key watch points include upcoming earnings and guidance from large tech and software companies, flows into and out of emerging markets, any sign of stress in credit markets that challenges today's calm, and changes in central bank communication as they weigh growth, inflation, and financial stability. How these elements interact will set the stage for the next phase of market drivers across both AI, exposed assets, and a broader global opportunity set. To wrap up, AI remains the key structural force, but has moved into a harder proving phase, with record Capex plans colliding with growing investor demands for demonstrable returns. The macro backdrop still leans toward growth acceleration, helped by technology investment, robust consumption, and improving global breadth, yet rising debt, labor market shifts, and potential policy or regulatory pushback keep the risk range wide. Markets reflect that tension through sharp divergences across sectors, sizes, regions, and asset classes, making dispersion, credit versus equity signals, and the evolving pattern of leadership critical to track in the weeks ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.